So I wanted to give away some free money and make an options trading tutorial. And today, to start, long options calling in particular. There are other forms of option strategies where you can use call and put options to hedge risk. In long option calling, the most you can lose is your initial premium, so it's a good one to start with. You can make a couple of $100 a month doing it, and best of all, you don't need huge amounts of capital requirement. I thought it would be a good idea because options trading seems to be complicated, but it's not. I like it that it seems to be complicated because it keeps all of the buy the dip, YOLO, Reddit over Bloomberg for information type of people out. Wall Street likes to make things complicated, probably for reasons like that. The options market can behave rather more efficiently, per se, than obviously the crypto market, but also regular equities. And like I said, all with less capital requirement. So you'll often hear the term long and short. Think of buyers and sellers. Long buy, short sell, simple. Purchasing is a key word. Purchasing a call option is a bullish move. It means you believe that the price of the stock will go up. It gives you the ability to profit off of a stock going up for a lot less capital. So let's say you want to buy one options contract. One options contract equals 100 shares of the option to buy, let's say, 100 shares of Apple stock at $115 on a certain date, June 18th, for example. This date is called the strike date. Currently, the share of Apple sits at $125.45. The price for this contract, known as the premium, sits at $11.42-ish. It fluctuates. Times 100, so that's $1,142. The price of the premiums, this $11.42, is determined by time value factors. The more time you have in between now and the exercise date gives the premium more value because then it just behaves like a regular stock. So there's an entire calculation that involves complicated calculus behind this. It's called the Black-Scholes model. We don't need to get into that, but just know that more time, more premium, less time, less premium. Also, factoring probabilities of where likely the price of the stock will be, it will lie at a certain date. Eventually, all options will come to zero time value because one thing's for sure, and that's that time can't be stopped. Now, the price of the stock is $125.45. It's in the money for a call. I'll explain in a later video, I'll explain why it wouldn't be in the money for a put. But it's in the money because the market value for the stock is greater than the strike. Nothing to do with the premium. So, you add the strike price plus the premium, that's $126.42. 115 plus 11.42. That's your break even. You're hoping that on June 18th, the stock lies above $126.42. So let's say Apple stock on June 18th, fears of inflation is lax. Everyone's on board that inflation fears are just simply due to pent-up demand, that slightly higher inflation above the Fed's target 2% is okay because it's been hanging below that target rate. Or Tim Cook gets on the stand on court and testified and all goes well. Whatever your hunch comes from. Let's say that Apple stock is at $130 on June 18th. So think about the cash inflows and outflows. Okay, $11.42 premium per 100 shares. So you spent $1,142 for this one options contract, cash going out. You gained 130 minus 115 strike. So when you sold the contract on June 18th for $15 times 100, $1,500. Your revenue is $1,500 minus 1142, an extra 358 in less than a month without having to put up capital to buy 100 shares of Apple, which would have cost you like $12,540 something dollars. Now, there's still risk. There's always risk in any investment. Any financial advisor telling you that there's no risk in an investment, run the other way. But you can only lose as much premium as you paid, because if on June 18th, Apple stock is below 115, you have the option to not exercise that contract. Let's say that the stock flops, it's at 119 on June 18th. You take 119 minus 115, that's $4 times 100, 400. So your net loss would be 400 minus 1142, so you'd have lost $742. But remember, you can never lose more than 1142. Options trading stable companies like Apple is great. The stock lied in the last 3 months between 116 and 134. It's important to look at these trends when determining what contract you're going to buy, though. Remember, you can choose to sell the options contract before expiration date if you believe it would be more profitable. The prices fluctuate during market hours because they behave just like securities. That's the way I look at them. In the next video, I'll introduce combinations of call options and put options called straddle option strategies. That's something else. I know times are crazy, but there are different tools in investing you could use. It's not just buy the dip. Take advice from a financial professional. Read the news. Keep the notifications on your phone from Yahoo Finance and Bloomberg on. Joke around on Instagram and Reddit, but don't take those sources of information literal. The goal is to get rich slow, maximize gains, but at the same time, with the lowest possible risk. Have fun options trading. Just make sure it's not your rent money for next month or something. All right.